Okay, guys, thanks for waiting for a few minutes and allowing some other people to join. And overall, thank you for joining this webinar today. Today we're going to talk about venture capital funding and pitching, and it's a topic that we got a lot of questions about from the startups that we work with. Before I go into this, just kind of like a reminder, this is actually part of a webinar series for startups that we're running as part of AWS Activate. AWS Activate is our program that we've designed to provide startups with the resources needed to get going on us. And I thought I'd share a few things with you guys in case you've not joined yet. Or if you've joined, it's good to kind of like get a better view of some of the things you can do with it. So what a lot of people know, as you can see here on this slide, that there's a number of different things that you get as part of AWS Activate. And a lot of people are obviously familiar with the promotional credits. But it's actually important to realize that there's a lot of value you can get over and above that, and specifically in areas like support and training, as well as special offers. So if you want to get your development environment in the cloud, Nitrous.io is a great solution. There's some things around security, obviously orchestration and DevOps with things like Chef or leveraging Stackdriver. A lot of valuable things there. As you might know, there's two different packages. And both of them deliver many benefits. The self-startup package is basically available for any startup. The portfolio packages is those that are available to co-working spaces, accelerators, incubators, seed funds, VCs that we work with, and it gives you a bit more benefits. One of the key benefits of that one is that you're actually getting business level support for free for 1 month to 1 year, depending on which program you're part of. And that would also give you access to something like Trusted Advisor, which is a very, very powerful automated tool that tells you exactly where you can optimize for cost, where you've got security issues, what's going on from a fault tolerance and performance point of view. So I thought it would be good to kind of like briefly mention some of these things. And obviously, if you haven't done so already, you can sign up here. So that was just a quick overview on Activate as part of this webinar series. Now let's talk venture capital and funding and pitching. You might ask yourself, why are we talking about this? As some of you might know, my role in Amazon Web Services is to manage our business with the venture capital and startup ecosystem across Asia Pacific, and we have a team with folks in Australia, Singapore, India, and some other markets, where we actually work with many startups and with many of the leading VCs in Asia Pacific. What's interesting, if you're a startup and you pitch to a VC, you know, those VCs get like hundreds of pitches every week or every month, and they don't have the time to give feedback to everyone. We do a lot of introductions between VCs and startups that we work with, and we actually do get the feedback on what the investors would like about a certain pitch and what they didn't like. So leveraging that information, we can actually relay that back and share that with you as value for our customers. In that sense, we're not biased. There's no agenda. It's just purely about helping AWS startup customers succeed. And within Amazon, there's very much a mindset of we win when you win and only when you win. So if you win, if you do get funding at some stage, then that's a great win for you, and that's great for our customers. So what we'll talk about today is an overview of the venture capital industry, if you like, and how it works. We talk a bit about the impact of cloud on venture capital, and then we're going to talk a bit more about what a good pitch looks like. Before we do that, however, I've got a couple of questions for you. So this is the only part where we have questions. We have two Q&A sessions, one in the middle and one in the end. We'll also ask you later on at the end of the session, there will be a pop-up to provide your feedback to these sessions, and there might be another question. So we'll get there later. But for now, the first question is, do you currently work for a startup? Let's see, give it some time to see the answers to that. So we have about 60% working for a startup, about 35% planning to join a startup or setting one up, and 10% love working for large companies. All right, great. That's good to understand. Second question. Do you have experience with venture capital fundraising? let's see. It's good to understand before I start talking where we are on that. Okay, looks like about 50–55% have no experience at all. 30% haven't got the experience but are planning to raise funds for their startup. About 15% have raised from friends and family. They sometimes talk about the 3 Fs, friends, family, and fools. And about 4% have raised funds from VC firms. So for them, for those guys, this might be familiar material. That's great. So that gives us a good overview. Cool. Let's get going. So the overview of venture capital. If you think about it, if you think about university endowments, if you think about pension funds or large banks or very wealthy individuals, they tend to want to build an overall portfolio of investments. That goes from mutual funds or even government bonds being like very low risk, low return type of asset classes to the other end of the spectrum, which is much more high risk, high return type of investments, which is where venture capital sits. Now what they realize is that these institutional investors might want to invest in startups but don't have the experience themselves to do so. So what they actually do is they invest it in a fund that is set up by a VC. So if you think about it, the venture capital firm itself raises money itself, step one. It raises from these individual or institutional investors. It then has a fund of, let's say, $100 million, and it starts investing that, step two, into startups. They're investee companies or portfolio companies. Those are actually the startups. They often have a long time span, 5 to 7 years, in which you could call it incubate, but not as an incubator, accelerator type business, but purely in terms of having these startups in their portfolio, helping them with business development or strategy or other value-added services. And ultimately, they sell the stake in that company in a trade sale, or they take the company IPO. Both of those options are referred to as liquidity events, where they basically make their equity stakes liquid, and the capital gains are distributed back to the individual investors. So if you think about that, it's kind of like a situation where the VC fund sits in the middle. On the one hand, they have the limited partners, the institutional and high net worth individuals, and on the other hand, you have the startups with a need for capital, and obviously with a potential to grow. Otherwise, they would not, justify investments. So if you think about that, it's very much a two-sided platform model, where on the one hand, the venture firm is trying to reduce risk and deliver financial returns to their limited partners, the investors in their funds, and on the other hand, they're trying to provide capital and support the value creation process for the startups by leveraging their connections, doing business development, supporting go-to-market, doing mentoring, and things like that. So a lot of people then ask, how does a VC make money? And if you pitch to a VC, it's important to be aware of what makes them tick, what are they looking for, and hence it's important to look at what their objectives are and how they make money. In summary, they make money by what's often referred to as 2 and 20. What does that mean? It basically means 2% and 20%. So the first one, 2%, is a management fee. So when a VC raises a fund of, let's say, $100 million, it tends to get 2%. Sometimes it's a bit higher, sometimes it's a bit lower. $2 million per year to operate the fund. So pay for the staff, expenses, rent, travel, whatever. The real kicker, the real money they can make, however, sits in the 20%, which is the performance fee. So I just mentioned that cycle where a VC raises a fund, then invests that money, and ultimately go through liquidity events, be it a trade sale or an IPO, and sells their stake, and it will obviously sell that, and that's the goal, as you can imagine, at a profit. That profit is shared back to the limited partners, but only 80% of it normally. 20% of the profits is the performance fee that the VC gets to keep. For some of the top funds like Excel Partners, Sequoia Capital, Andreessen Horowitz, for some of those guys it can be up to about 30%, but the industry average is 20. So that's a 2 and 20. So that's in the mind of a VC when you come to pitch. Is like, how can this guy deliver a return for me and the benefit there. So if you think about venture funding, it's important. It's not just like I raise yes or no. There's a lot of different cycles in that fundraising process, and we'll talk about that later. Here's an interesting infograph from fundersandfounders.com. It's a bit complex here, but let's focus on the top there, which kind of like looks at the various stages. Where in the early days you might have just a simple idea, and you might raise whatever, $15,000, $20,000, just you and your co-founder. You might raise that from family and friends, maybe from angel investors. Then at some stage you go to your seed round, and you might raise a bit more, maybe anywhere between $500,000, $1 million. And ultimately you're trying to go for your Series A. And then what you see on the right is your IPO. What's pretty small between Series A and IPO is some more series of funding. Actually, that often is the bulk. It's your Series B, Series C, and so on. The key question I often get is the question of, if I take money, I need to give up equity, so I'm kind of like diluting my ownership of the company. So it's interesting what they say in there is that 100% of nothing is a lot less than 70% of a big company. So sometimes it's better to actually give up something of that 100%, because you get the capital, you get the connections, you get the support from an investor that can actually help you make it really big. So even if you own less of a big company, that's still a lot of value. So let's look at an interesting scenario of a company that did that. There were three guys, Nathan, Brian, and Joe, in August 2008, and this is a real-life example. And they raised some money from Y Combinator, about 20K. About 4 months after that, they got a 600K seed round from Sequoia and University, and then raised their Series A in November 10. Interesting, I just mentioned that after Series A there's often a lot more things. In July 11 they raised another $112 million. After that, by the way, they raised another $200 million, and just now, 2 months ago, they raised another $450 million. This company is Airbnb, so you might have heard of them, but it's interesting from that point of view that, you know, as a company they've gone exactly through these different stages. For those of you that have attended some of the cloud cutters we've organized or seen some other webinars, you might recognize this life cycle of a startup that we often use as a framework for talking to startups about how AWS supports them. And one of the things we often talk about is the different challenges that we see startups go through at the various stages. So in the early stage, going from idea to minimum viable product, they often talk about, like, product. Is there really a product? Do we have a product? Can we ship it? Can we develop it faster? Does it actually really work? Assuming you get your MVP out to market, your question tends to be more around, you know, do people actually buy it? And if they buy, do they pay for it? Can we scale? Can we deal with spiky traffic, for example? And ultimately, you want to make money, so you want to focus on your business model, focus on monetization, whilst keeping your costs down, right, and staying profitable. If you think about it from an investor point of view, these are typical things that they'll look at as well. In the early days, it's much more around product risk. Later on, it's about market risk, and then it will be more around financial risk. If you think about that, and you think about the lean startup model, it's interesting to note that there's also people, specifically Dave McClure of 500 Startups, who I think dubbed the term the lean investor model, where back in the days you had nothing, you had just an idea, and you would raise $5 million or more, and I'll talk about that later. But now you see people being much more lean and going through multiple rounds of funding, where they might indeed, like you saw with Airbnb and Y Combinator, raise from an incubator or an angel, let's say anywhere between 0 and 250K. That tends to be focused very much around product viability, like reducing that product risk. And then the next round tends to be a seed round. It used to be kind of like between 250 and 1 million. It creeped up to about 1.5 million, and now people are saying that, you know, seed is a new Series A, and you see people raising crazy large seed rounds. But still, overall, it's very much focused on expanding market distribution. So dealing with that market risk that we mentioned there. And then your Series A, your proper venture round, you know, that's where you start raising 1 million to 5 million or even more, and ultimately, as you grow your company more, there's the potential B, C, D rounds, and so on. So here's another way to look at that in terms of values and how it kind of like ties up to the various stages of your life cycle as a startup. So what caused the evolution towards the lean investor? That kind of like brings us to the impact of cloud on venture capital. So actually, before going into that, let me pause for a second and see if there's some questions specifically about this first part about around venture capital. There's a couple of questions that I've got in already, but if you have some additional questions, feel free to type it up in your screen. Okay, let's see which question I'll take. So a question we get a lot from people, and I can see it here, is basically around at what stage do you need to start speaking with investors? And one of the things I'm seeing in the market is that very often it takes quite some time to actually raise money, and hence it becomes important to make sure that you stage it in time. So if you have a certain runway left, in other words, the time that the money that you existingly have will last, you have to start planning well ahead of time so that you start raising. Some people start the process early, and there's different points of view there. Some people say that investors hate the fact that you waste their time by talking to them when you're not actually raising money. Whereas if you're upfront about it and you basically start talking with them and sharing information, but you're actually saying that, hey, we're not raising now, but we want to kind of like start the relationship with you. If you're interested, we can keep you posted, and then so that as and when the time comes that I do need to raise money, then we're kind of like ahead of the curve and we can make things a lot easier. So that's another way to look at it. Let me see. One other question is around the types of funding, and it tends to be that Series A tends to always be equity versus seed rounds and angel rounds. Sometimes it's equity, but very often it's convertible notes as well. So talking about the details of convertible notes versus equity versus some other mechanisms that have cropped up in the market, some of them driven by Y Combinator as an example. They've developed a tool called SAFE. Those are that's too much to go into for this session, but that's something that you can read up to. But you see a lot of convertible notes these days. One of the other questions you got is how to find the right VC for a product. It's actually an interesting question. There's a lot of folks that sometimes ask us to make introductions to VCs, and there's so many out there. So it's very much about looking at what stage is an investor investing in. Is he a seed investor or a Series A investor? They also invest in different verticals. And I once worked with a startup that I was helping to connect with some investors, and they came exactly with a list of 4 investors where they found out from the different partners there, and they knew exactly which partner, which investor had a background, in their case, in semiconductors, and that's why they wanted to speak with them. So if you ask about how to find the right VC for a product, it's very much about thinking about what those VCs have experience in, because A, that's what they'll invest in, and B, that's how they can add value to you. So if you're working with an investor and you're in semiconductor and they've worked for 10 years for Intel, now being with Excel or Sequoia or whatever type of investor for a long time, then there might be a good kind of like startup VC fit. Let me see, a few more questions. I'm getting one question, a sample pitch deck or templates you can suggest. There's quite a few available. Actually, the last part of this session will be purely around a template that I'll walk you through, so that might help. And there are some interesting materials out there that you can Google. There's some links, and perhaps we can find a way to share those as well. Obviously, there's a lot of questions that we're getting around crowdfunding. So one question we've got here is when do you use it, and what should startups go through crowdfunding platforms like Kickstarter? When the crowdfunding platform started coming up, there was a lot of people that said, like, this is the end of venture capital. Actually, the opposite is proving to be true, or maybe not the opposite, but it's actually not really going against venture capital. What you see people do is a VC would only invest in a company when they can demonstrate product market fit and demand and traction. Now you can prove that product market fit and get that traction through seed rounds or through angel investors, but another format is crowdfunding. So there's a lot of people that as the first step actually launch a crowdfunding campaign, and only when that crowdfunding is gives them the initial money they have, they can then go to investors and say, now we need to set up production, or now we need to start executing or expanding globally, and we're going to scale. And here's, the crowdfunding campaign is our proof point that there's demand for this. I've also seen some other people that raised, there's an interesting company here in Singapore, Pirate 3D, that is developing a 3D printer, and they raised a seed round of about 600-700K Singapore dollars, so about $500,000. With that, they developed the product further so that they got it to a stage where they could start to set up a campaign from a crowdfunding point of view, and that basically got them a lot more traction. So there's different models of using it, but it definitely is proving these days to be much more complementary than anything else. Well, let me see. Some people are asking. About return on investment, and specifically for angel investors. And for angel investments, it's very tough to answer that question because it really depends on the type of angels. And some angels invest purely for an ROI, and a lot of others are investing much more to help and work with startups. If you look at VCs, it's a traditional saying of they look for 10x returns. So they look to basically see the value of their investment go up by 10 times. That's what a good investments look like. So there's different ways of looking at that for different stages. Anyway, we'll try and keep some Q&A for the end. Let me move on to the next part and talk about the impact of cloud on venture capital. This is an interesting quote from Mark Sester, who's a serial entrepreneur and currently a managing director with a rather successful VC in the US. He did a series of blog posts where he talked about how Amazon changed the VC industry. And the next few slides kind of like talk through his thinking and how he explained it, and it's pretty interesting. And he basically took the approach of looking at history and looking at, let's say, before the dot-com boom, 1995 to around the year 2000, where technology startups required a lot of physical hardware, a lot of big boxes, Unix servers, and proprietary whatever, Oracle licenses or whatever to build their business. If you then wanted to do a startup, you needed a lot of money to get going, often like $5 to $10 million just to start building your idea. A lot of that money was normally spent on infrastructure, on marketing, sales, and so on. And innovation-wise, it was difficult. It was very costly to do experimentation. Then around the year 2000, think of that as the rise of the open source. So now open source software drove technology costs down by about 90%, or at least the software costs down by 90%. So the only 10% that you could still pay was your, let's say, your Red Hat licenses, your maintenance, and so on. So what happened is that a typical Series A went down by $3 to $5 million, or to about $3 to $5 million, and it was spent a lot more on open source things like LAMP-stack, Linux, Apache, MySQL, PHP. A lot more was spent on development, and there was a lot more innovation, right? Because experimentation became less costly. But unfortunately, there was still a lot of money spent on infrastructure. And then 2005 was kind of like 2005, 2006 was kind of like where public cloud got pioneered, where AWS got started and started driving total operating costs down significantly. So typical Series A went down significantly, or you start seeing this shift where they often say that seed is the new Series A. First Series A came down, now Series A is starting to be later, and seed stage or even pre-Series A start taking up. So the whole landscape is kind of like changing. And the money is much more spent on staff, the battle for talent. And we see that here in Asia, where talent is not often easy to find. Even in Silicon Valley, where there is a lot of talent, but there's also a lot of demand for it, so people are competing for talent. And what we've seen from an innovation point of view is an absolute explosion in experimentation, a lot of innovation, and so much more startups. And that final part has actually driven this trend, and that's what Mark Sester was talking about, how Amazon changed the VC industry, because it actually spurred this explosion in the number of startups, but also the emerging of micro VCs. Micro VCs or seed funds, or could take different forms. It could be the angels or the angels that unite in terms of like angel funds or super angels, incubators and accelerators, of which, just in India, some people are counting that there's like 40 to 80 of those just in India as an example. And then VCs, obviously the venture firms, but there's a number of them that have specific seed funds or specific focus on early stage, or you have ones that are specifically focused on those. Like Matrix Partners has a seed fund, Andreessen Horowitz is doing seed rounds. 500 Startups is purely doing early stage rounds. So that is an interesting dynamic, and that has basically led to a massive influx of capital for those early stages. An example is 500 Startups, which these numbers are a bit outdated, but when we counted it some time back, there was about 28 startups in Asia that they funded, and 21 of those were in AWS back then, which was obviously about 70%. And that ranged from guys like QB Messenger in Taiwan to Paywall Hero in the Philippines, or Drop My Site in Singapore, 9gag in Hong Kong, Doodle in China. So all over the market, and that's interesting. And it's interesting to see why VCs care. Why do they care about public cloud? Why do they care about AWS? Well, obviously they're seeing more deals, right? They see shorter time to scale. People can grow really quickly. People can go global instantly, and that also means faster time to revenue. It lowers the burn rate. In other words, the rate at which they burn the money that they have, and sometimes it's even higher valuation at exit because of some other dynamics. So it's interesting from that angle how cloud has had an impact on the VC landscape. So let's get to the last part around the pitch, and there was a question just now about a template or resources. So I'll talk about a template in a second, but first, I see a lot of pitch decks, and it's interesting to see a few things that are always there. Now, as you can imagine, a lot of startups are developed by engineers, and they build stuff, and they love to talk about the stuff they build. They like to talk about product. So often, a lot of slides are very high on product and very low on business or on finance. Every pitch deck I see has this infamous hockey stick curve, this very rosy forecast. But there's a couple of things that tend to be missing, and I'll talk later about how you might embed those in the template for your pitch. What tends to be missing is the business model. So it's not just about what you build, but how are you going to build it and how are you going to make it successful. Related to that is metrics. If an investor invests in a business that's 10 years old, it can just look at the trends on the balance sheet, income statement, cash flow statement, and so on. But when you're a startup, there's nothing like that, right? So the only thing you can go by that is somewhat quantitative rather than just qualitative is metrics. And not just around traction, but more around unit economics and so on. But I'll dive into that in a bit more detail later on. And then third, strategy. I've noticed that a lot of startups see strategy as this dirty word. They just think about it as corporate ivory tower type strategy. But if you think about strategy as purely like what will you do and how will you grow, so what's your growth plan, how can you actually execute on all the things that you say you will be doing, that's not fluffy or ivory tower type strategy, but very hands-on, action-driven strategy, and we'll talk about that in more detail. Now, if you think about a pitch outline, again, and this is kind of like a bit of a caveat or disclaimer, there is hundreds of templates out there. There's hundreds of formats, and there is no right or wrong, right? What I'm talking about now is not me saying that this is the right way or the only way. It's just a way, and it focuses on some of the things that I've seen investors care about, and when people who have done it have actually done well in fundraising. So it's just me sharing that, but by all means, look around, read books, read articles, and familiarize yourself with things that are with other models or templates. Anyway, one outline is the so-called 10-20-30 rule by a guy called Guy Kawasaki, who was used to be the chief evangelist for Apple and got into the venture capital industry as well. 10-20-30, 10 slides, 20 minutes. No font size smaller than 30. In other words, keep your presentation brief, both in number of slides, 10 and in how long you take to present it, about 20 minutes, so that you have more time for a Q&A, assuming a 1-hour meeting. And make it very visual, make it very bold. Use a lot of large font instead of small print. To some extent, you can see my presentations always being that same thing, more visual, with less smaller things on it. He actually defines exactly the 10 slides that he says you should have, which is slightly different from the ones that I'm proposing here. So I've kind of like altered his approach to focus on these things that I see are often missing and focus more on those. So let me talk through the first 5: problem, solution, business model, metrics, and growth strategy. The other ones are a bit more self-explanatory, if you like, yet very important. So if you think about problem, I mean, it's interesting. It looks, a lot of the pitch decks actually start with a problem. If there's no problem you're solving, then why bother, right? But if you think about the problem, there's different ways to describe that. And what's important is to be able to, A, define the problem really clearly, but then also explain the impact. Why bother? If the impact is, if there's a problem, the impact is very narrow or small, and very few people have it, then why bother, right? Is the problem worth solving? Is a question you might answer. You might ask yourself. If the impact is really, really big, more people would have the impact, or the people that do feel it care deeply about it and are willing to spend money to solve it, for example, then that impacts the size of the market as well. What's the opportunity? What's the market size? So in a way, you know, you can have separate slides around problem or market, because they're not. It's not always like easy to see exactly the link, but you can think about, like, the more people have a problem and the bigger the problem is for them, then the market is bigger. And what you see in the right top corner is some people say that basically a clear problem in a large market define a great opportunity. So one company I've seen, it's called Plunify, that's doing cloud computing for chip design, that phrased that really well, where they basically had a very clear problem where they say that chip design has gotten more complex, but the tools to do chip design have not improved. That's the problem. What's the impact? Well, there's a lot of semiconductor and chip companies out there, and they're all facing product delays, increased cost, and less collaboration, less quality as a result of that, right? And they knew exactly that there was a $5 billion market for electronic design automation software that they were getting into. So they could very clearly articulate to the investor, and they raised a seed round in Singapore, you know, how the problem and impact was actually resulting in a certain market size. When it comes to solution, this visual has been taken from the Entrepreneur Pitch book that's been done, and that's freely available on the website by Canaan Partners, which is a really interesting deck. It obviously talks about, you've just described the problem. Now, how can you really make us understand how you'll solve the problem? And not just how you do it, but how you do it different and better than that someone else is doing it. You can obviously just describe it, but as you can see on the right, it's better to show it, for example, with a video, or the best thing is you got it up and running and you can show it in a live demo. Now, a key part that I focus on, and the reason I focus on it is because most pitch decks don't talk about it, is business model. And there's often a slide that says business model, but then it just says price, it just shows the pricing, or it says, oh, our business model is freemium, or our business model is SaaS. I like to take a slightly different approach, and one book that a lot of people in the startup scene, you know, you read Eric Riesling Startup, Steve Blank, 4 Steps to Epiphany, or the Startup Owner's Manual, and another one that a lot of people look at is Business Model Generation, which introduces the concept of the business model canvas and how you can use that canvas to basically describe and iterate on your business model. It consists of 9 building blocks, and I won't go in detail here, but what's interesting is that, you know, you see a lot of people focus on value proposition, just their product, but you have to ask yourself not just what the product is, but also what the value is it delivers to your customers. So what is the pain point that the customers are facing, and how is your product actually solving that? So those two, value proposition and customers, think about those two together as your product market fit. Example was Amazon.com. When we launched, the product was like selling books online, but the value was very focused on 3 parts: low cost, convenience, and choice, like having a large inventory. And if you think about it, you can think about the left side of that as the capabilities you have, and the right side as how you use those capabilities to make money. So it's one thing to say to an investor that you have a certain value proposition, but you can give him a lot more faith in your ability to execute on that if you can clearly articulate the key activities that you perform, and the key resources that you have and the partners that you actually bring to the table that can allow you to do that. And if you think about it, pivoting or iterating is kind of like changing as little possible on the left side to maximize the impact on the other side, right? So I'll use a few slides from a pitch deck that has been really good, and that company has gone like Airbnb, although it's earlier, through the ideal cycle of having some angel money, then raising a 700 or 800K seed round, then a $2.5 million Series A, and recently a $10 million Series B. This was their deck even for their seed round. And what it did better than any deck I saw was actually describe the customer. And it's interesting for us. I mean, I work for Amazon, which is a very, very customer-obsessed organization. Many pitch deck I see do not even talk about the customer. It describes a problem, but they're not going into detail about who the customer is. And for a lot of e-commerce companies, if you talk about it, it will just say, oh, it's people that are online. Well, that's rather generic. This is Luxola is an e-commerce company focused on cosmetics and beauty products. And as you can see here, it describes the customer in great detail. It also describes in detail how we work. So what I'm not suggesting is you taking the business model canvas and just basically filling it out and putting it on a slide. But this is a very elegant way of actually showing that there is a value proposition, but they actually thought about all the key components, everything that they need to have, like warehousing, everything they need to do, like marketing, to actually make that happen, right? Focus for now on marketing. There's a lot of pitch decks that if they talk about they do marketing, they have a list here, but as you'll see later, Luxola went to a lot more detail to actually look at what they will be doing in those areas. So the list here, SEO, SEM, digital media, I'll get back to you on that a bit later. Now, a key part then is actually metrics. So it's great to have a business model, but what are the dynamics within a business model that drive the outcomes, that drive the result? Phil Moore is a guy who is an ex-startup founder who works for Pollenizer, kind of like an accelerator incubator in Australia. And you know what he's saying is that he looks for signs in a pitch that the founders understand the mechanics of the business, the dynamics, mechanics, the metrics, and so on. And that's crucial. And one interesting model that you see there is Dave McClure's, what he refers to as pirate metrics. The acronym there is R, and that's apparently what pirates are saying. So how do you find users? Do your users have a great first experience and actually activate? Do they come back? Do you retain them? And then can you make money? Can you drive revenue and drive referrals? So if you think, for example, about a mobile app or mobile app business or a mobile game business, for example, if you think about acquisitions, think about installs or sign-ups, and ideally break it down by campaign or channel. Think about conversion, and obviously think about customer acquisition costs. Activation, this is where you start looking at monthly active users, daily active users, tracking all of these things. Retention, that normally has to do with engagement as well. They often measure daily actives over monthly actives and look at that ratio. They look at retention at day one. Have people just activated, tried it, and never used it the day after, or are they still active a week after or a month after? Revenue, there's obviously a lot of different things that you can track. A lot of people do average revenue per user or average revenue per paying user. But you can also start looking at the percentage of your user base that's actually paying, the percentage of them that buy in-app, the percentage that can be seen as whales, so your top users versus your mid users, sometimes referred to as dolphins, or the bottom, your minnows as they call it, and obviously lifetime value. And then finally, refer is what they often use as the K factor, so the number of invites sent per active user times the percentage of acceptance or conversion rate. And within these metrics, you can actually start looking at some lines in the sands or things that you should focus on. So Fred Wilson, Union Square Ventures in New York, it was an avid blogger on avc.com, as you can see in the bottom, talks about the 30-10-10 rule, or sometimes adapted to a 30-10-1 rule, where he basically says that from your registered users, you should aim to have at least 30% to be monthly active and 10% to be daily active, with a 1% peak concurrent users. So if you look at that, it actually means that daily actives over monthly actives should be around, 33.33, or what some other people are saying is over 0.2. So these are metrics that if you see, if he looks at your deck, he starts asking those types of questions, right? He looks at those metrics and starts saying, hey, your monthlies is good, but your dailies is not, so your engagement is not that good. Or when it comes to profitability, specifically for subscription businesses, SaaS businesses, or mobile subscription or web subscription-based models, they look at a good business is when lifetime value is at least 3 times as high as a customer acquisition cost, and where it should take less than 12 months to recover those customer acquisition costs. So these metrics are really important. And the drawback is that some people start basically describing very, very long list of metrics. But if you think about it, your revenue tends to depend on a lot of different things, on different revenue streams, and those different revenue streams depend on different other metrics. So it's not often a one-dimensional list of metrics, but much more of a cascade of metrics and KPI that impact each other. And it's actually good to start really thinking it through in that way, and then start looking at which of these metrics, which of these KPIs can I influence, because some of them you might not be able to influence. You can then start looking at, from the ones that influence my revenue or my unit economics in the end, which of them have the highest impact. And let's say that, advertising click-through rate or average basket price for an e-commerce company, let's say that those things are important. What you can then start doing from a business model metric point of view is make sure that as part of your pitch deck, you can talk about those metrics. It shows, as the quote from Phil Morrow just showed, that you understand not just the technology and not just the product, but you understand the business and you understand the mechanics and the metrics that drive your business. And ideally, you want to be able to show exactly where you are right now. If you can, show where other similar companies are, comparables, comparable A, B, C, as you can see here. And from that, you can define your goal, right? So my advertising click-through is now 1.5, for example, and I want it to get to 55% or whatever, right? Now, I talked about strategy as well and how that's often missing. Often you see that hockey stick, but you don't know what's driving that. What you can start doing here is, if you have those metrics and you know where you are and where you want to go, you can be very specific in how you want to set up your growth strategy, what actions you want to take to get from where you are to where you want to be, right? And this shows very much a bottom-up approach to your strategy, and a very action-driven approach. You can build on that by then saying, well, actually, those actions and those activities will cost me X number of dollars. So now you can be very clear in how much funding you ask for. And what I see happen a lot is you see a pitch deck, and at the end it says, oh, and I want to raise $500,000 or $1 million. But that amount comes often from nowhere. If you ask, like, why do you raise $1 million or $500,000? Well, it's a nice round number, or we just think that will be enough. And if you ask, what will you be spending it on? Well, we'll hire some people or we do some marketing. An approach like this is very metrics-driven. It's very action-driven. And what you're actually doing bottom-up is you show what you'll be doing with that money. Not like I have $1 million, here's how I'm going to spend it, but here's all the things I'm going to do to get from where I am to where I want to be, and that's why I need X amount of money. Now, as an example, I mentioned earlier on the slide from Luxola around the marketing things, and on that slide they just showed SEO, SEM, digital media buys, and so on. But their pitch deck showed in detail exactly the description of what they were going to do there, what the target was, the KPIs that they were focusing on, frequency, cost, and obviously that total budget you see in the bottom right corner would be exactly what would go into their overall ask from a marketing point of view. So it's a very solid, detailed growth strategy, if you like, from a marketing point of view here. So that was kind of like talking through the template that I'm kind of like suggesting here, or that you might be able to find value in. Now, when do you need to have what? So we talked earlier around the different stages of you as a startup and the different types of money you could be raising. So you will be pitching for different types of money at different stages. And if you think about it, an angel investor, what they normally say is, show me a great idea, show me a problem and a solution, show me hypotheses or things that you're going to test, and show me that your team is the right team to test those hypotheses and to further develop the business model and the metrics and the growth strategy and so on. At that stage, it's hard to expect a fully fledged idea, fully fledged product or business. But a great idea with a great team of founders that can take it forward is very important. When you go into your seed round, then what they normally say, show me traction, right? What they want now is not just a team and some ideas or hypotheses, but much more detail around problem and solution. There needs to be more clarity about the business model at that stage. There needs to be, point 6, much more traction and an overview of where you are as a business. Now, the question is often like, what is traction? When is something, some people say, yeah, I have 1,000 users, so there's product market fit, I've got traction. Whereas other people say, well, you need a lot more for that. Ash Fontana was one of the founders of AngelList, did a presentation, and here's a picture of that, and it might be hard to read. But what he's talking about is when you're doing your 1 million seed round, product should be taken care of, team should be taken care of. It's around traction. So if you're an enterprise product, that traction might look like 1,000 seats sold at $10 a seat per month, or what he says, big enterprise, so that's more like your bespoke projects instead of your SaaS business. You might need 2 pilot contracts with some dollars of revenue. If you're doing a social business, maybe you need about 100,000 downloads or signups. Marketplace and e-commerce, like 50K revenue per month. That's not little. That's quite a lot. And some of those numbers might be different here in Asia than they are in the States, but it's interesting to think about it in that way. And then finally, a Series A pitch. I talked about 2 and 20 later on. So that 20% is 20% of the returns. So, a Series A investor, wants to not just see a product and not just traction, but really a business and returns. And all the things that you can see on the right need to be completely fleshed out by now, and you should be able to talk confidently about a lot of these things and more. So, with that in mind, before you pitch, you should really ask yourself some important questions in terms of, where is my startup in its life cycle? If I'm really early, if I'm just getting started, then I might need to, focus on the solution and the problem, the team, the hypotheses, and talk to angel investors. If I'm getting some traction, then how can I, accelerate the traction further and speak with the right seed investors and so on? And when I do I really understand my business model? Can I show investors that I'm not just a technical or product person, but someone who can actually build a business and focus on metrics and returns? And again, all these things tie into which investors you need to speak with. So that's kind of like the homework you need to do, like thinking about what you look for in an investor. Easy money or money that has some more strings attached. For example, it's in places like Singapore or some other markets in Asia, like Korea, where the government is actively supporting the startup scene. Sometimes it's easier to get money, but then at the same time there's strings attached from a reporting point of view, so it's not always as easy as it seems. And then there's obviously the dumb versus the smart money. What I mentioned earlier as well, investigate who you want to marry. And I say marry because a lot of people say that, if you get specifically a VC firm involved that you're going to be working with for 5 years or maybe longer, it's almost like marriage. And you really want to know which firm you want to do that, and preferably which partner in that firm can help you and is best positioned to help you. And lastly, speak with people that know these investors. So speak with business partners, speak with people that are in their portfolio or that have worked with them. All these things are hugely valuable. So with that, we're coming to the end of this webinar, but we have about 5 or 8 more minutes to see if there's some additional questions. So let me see if there's some more questions. Again, feel free to type in some more questions in the screen for that purpose. Let me see. So one person is asking, how important is it to share equity with angel investors, and do we have options to offer something else? So as I mentioned earlier, some angel investors are taking equity, but it's much more normal these days for them to go for a convertible note, which is basically debt with the option for the investor to convert that into equity in a follow-up round. So and another thing is, and I've seen that in markets where the venture ecosystem is less mature, is where people that are not traditionally, that have not traditionally invested in venture, like for example in Australia, there's a big property market and mining. There is definitely a very interesting and growing venture ecosystem, but there's also been people that have less background in venture investing. I've seen the same in Indonesia or in other places. You have to sometimes be careful with money that comes out of people that are less familiar with venture deals and with venture returns, because it might influence your capitalization table, and it might influence your follow-up rounds that you might raise from people afterwards, who then might be struggle to get the right type of equity and return on investment depending on your initial rounds. So it's something to be careful of. Someone is saying, would VCs invest in services industry? That's actually a great question. Normally not. There are definitely exceptions. An interesting one in India is Mu Sigma, which is kind of like a consultancy firm in the analytics space that has grown a lot and raised, I think, over $200 million. But that's an exception. Normally what an investor looks like is what they refer to as nonlinear, the ability to do nonlinear scaling, and with little investment to scale like exponentially. Services businesses are normally people-based businesses, or what they say FTE, full-time equivalent-based businesses. So to grow my business by X%, I need to add X% of people. So that's linear scaling, not nonlinear. Having said that, there's a lot of businesses that start as a service business but then develop certain tools or products, and those products become scalable. And as such, you see these companies in the beginning of the early days, it's like 100% services. Then it becomes like 80% services and 20% product. And as long as you can show that over time, in a year or so, you can swap that around and become less reliant on your services revenue and much more on your product revenue, then that can be a very viable model. And there's a lot of companies that have gone that route and be successful. Let me see what other questions we have. So someone is asking about how much percentage we can dilute in each cycle of funding. In seed, how much? In the angel stage, how much? It really depends, and there's no right or wrong answer there. But what you normally see is a couple of dynamics, I think, as guidelines. A VC would normally take anywhere between, and it really differs again, but for a Series A round, tends to be between 10 and 30, with the magic number being around 20 or 25%. So what an experienced investor will always do is make sure that the founding team has sufficient equity that interests are aligned. So they won't want to create a situation where the founding team only has 20%. You normally need 20% for your employee stock option pool. The founders need to be incentivized themselves sufficiently. So all these things are important, and you need to keep them in mind. So if your angel round or seed round is diluting you to an extent where you cannot have a situation where for your Series A, an investor, a venture firm takes 20%, you have 20% left for your employee stock options, and you as a founder have still a majority share in the business, then you need to start worrying about that. So from that point of view, it tends to be that angel rounds, seed rounds, incubators, take a few percent, 5 to 7, but definitely less than 20 normally. So think about those dynamics and kind of like reason backwards from where you need to be later on. Okay, let me see some more. It's a great question. In a two-sided marketplace startup, so there's a lot of businesses that are two-sided models, right? If you think about LinkedIn, in a way, it's a two-sided model. On the one hand, it has the users, the consumers, and they get something for free. And on the other hand, it has the companies that pay for the service. Google search, it's free for the user, but the advertisers pay. And obviously, e-commerce models, specifically if they are auctions, for example, or so on, they're all two-sided models. What you need to focus on in a pitch is actually the Hello, let me see. Yeah. Okay. It seems. Sorry, guys. It seems that there was some problems with the audio. I think people can hear me back now. Not audible. Okay. So I'll finish the answer I was giving with regards to the two-sided model. So clearly, you have to start looking at the two sides of the model, and you have to articulate clearly how you're going to drive your growth and to both sides of the model. Which problem are you solving for them? So again, Google needs to be clearly able to understand how they solve the problem for the people that are searching and how they provide value, as well as to the advertisers. Things like that are quite important. There's a platform for learning, Udemy, that recently did a presentation, and the question came up to them like, which side of the model do we start with? Because it's like chicken or egg. You know, you have to have one model to get the other, and vice versa. And his answer was, you know, if it's a chicken and egg, you have to fake the chicken. You have to first fake one side of the model, or at least come up with a way to drive engagement on that side. And again, if you ask, like, what does an investor look for? You know, you need to be able to clearly show that you understand the two sides of the model and how you're going to simultaneously grow those together. So I hope that answers that question. Yeah, is it a question where someone says that rather than ask for a lump sum, is it possible that angels, you know, are interested in smaller amounts that are tied to attainment of certain milestones? Actually, that's a model that happens a lot, not just with angels, but also with venture investors, where they actually do different tranches of capital, and sometimes, you know, they announce the deal as being the whole deal, but actually there's conditions into it, or they announce just the first tranche and their subsequent round. But in the format that I described, you can basically be very clear in saying, hey, here's where we are now. You know, 100K or $1 million or whatever will get me to these milestones. Then I need X more money to get to that milestone, and you can actually use those types of milestones around metrics. So, in interest, we're out of time actually. Okay, we have a last polling question for you guys, because we're doing a couple of other webinars, and we want to see what got most of your interest in terms of the type of topics that you want to be discussing and you want to learn more about. So there's a poll open right now, and we're going to see what people are interested in. I'm watching the results come in right now. Thanks for answering and clicking. Kind of like as expected, people are really interested in big data and analytics. So we've got about 45% of the people being very interested in that. We've got about 35% of the people interested in reducing the burn rate of your startup, so how to do things cost effectively. Scalable databases. It's interesting. It's got only like 7 or 8% of the votes, and yet for a lot of fast scaling startups, is the #1 bottleneck. But it really depends on where you are in the life cycle of your startup for you to see that the importance of that one. But this is good information for us, so we can make sure that we can focus one of the next ones on big data and reducing the burn rate of your startup as well. So with that, thank you very much. As you wind down this webinar on your screen, you might get a pop-up screen that will ask you for your feedback. I hope you've enjoyed this and that some of the insights have been valuable, and thank you very much for attending. Have a great day.